So we know that there's these two product costing methods, variable costing, which includes direct materials, direct labor, and variable overhead. While absorption costing has direct materials, direct labor, and both variable and fixed overhead, right? And that's the big difference, is the fixed overhead is included in absorption costing while it's not included in the variable costing, right? There's no fixed components in the variable costing. Absorption costing is required by GAAP, but can result in misleading information and poor managerial decisions. And that's what we're talking about. It's meant for comparison purposes. So companies compare to each other. So investors and lenders can make decisions about who they want to lend to or invest in, but might not be the best for managerial decision-making and project decision-making, which is why we have variable costing. So they can have differences in income. And these differences in income may be small if the fixed overhead is a small percentage, right? Like this may be not impactful if we don't have a lot of fixed overhead, or if we have low inventory or no inventory, or if inventory turnover is really rapid, or if we're looking over a long period of time. But if we're using a lot of fixed overhead, so we have like a lot of warehouses and factories, if we have very high inventory levels, or if we have slow inventory turnover, so if we're like talking about building out cars, or some business like that, and then we need to sell, and we're analyzing a short period, we use the variable costing. And so you'll learn once you go in the business world, if you're doing like financial analysis, most of the time people look at variable costing, not absorption costing. Absorption costing is more of a GAAP concept or a financial accounting concept. So absorption costing versus variable costing. Just memorize this. It's not, what we're saying with variable costing is that fixed overhead is not included in the product cost. Well, in absorption costing, we are including it in. So, right, so under GAAP, we're adding in like the electricity from the factories into the product costs. Well, in variable costing, we aren't. So we're going to go through these in detail now on like computing unit costs, the difference between variable costing and fixed costing, variable costing and absorption costing. So let me open up our Google Sheets. Chapter 6. So let's say absorption versus variable. That's this whole chapter, because we're going to be going over absorption versus variable. Direct materials, direct labor, expected units of production, overhead is variable overhead, fixed overhead. So this goes back to the first chapters, right? Direct materials and direct labor and overhead make up the total product cost. We all know that. So we have 4 per unit, 8 per unit, making 60,000 units. Artisan soap. And then we have $180,000 in variable overhead and $600,000 in fixed overhead. Total overhead is $780,000. And so the question is, how do we allocate this overhead? Well, under the variable costing method, we wouldn't include the fixed ones, right? We wouldn't include the fixed. In absorption, we would for product costs. And so absorption cost, what's the cost per unit is the real question. So variable costs, variable product costs are here. We know the total variable product costs are 4 equals 4 plus 8 times the 6,000 plus our variable overhead. That's our real variable costs at that production level. We can also look at it per unit. And so per unit, we can say 180 divided by 60,000 is $3 per unit. and $10 per unit of fixed overhead. So now we can figure out product cost per unit under absorption costing and variable costing. Unit, absorption, materials, labor, overhead, variable overhead, fixed overhead. So under the absorption costing, we'll note that both of these are the same under absorption and variable. Right? All the time we have direct labor and direct materials attached to them. Then variable overhead, we also have in both. But our fixed overhead is only included in the absorption costing. So our total price per unit, total product cost per unit, changes drastically when we consider the absorption versus the variable method. The absorption says it's $10 more than the variable method. Does that make sense? So when I'm asking you on a test or a quiz, when do we use absorption costing, or how does it differ from variable? It's the fixed overhead. That's one of the largest differences to these methodologies. Any questions here? You can see why this is important for decision making, is because fixed overhead is something that we can't control, while these costs are controllable per unit, right? So how do we analyze an income statement now using these methods? So I know that the net income here is $580,000. We see the cost of goods sold is $25. And we have the selling and admin expense of $320,000. We know this is absorption costing. So looking at this, we can see that because it's absorption costing, maybe the net income is understated, right? Like they are only showing $580,000 in net income, but under variable costing, we might show much more. Okay, and then we're seeing the net income here. If we can compare this absorption costing to the variable costing, we can see the net income equals each other. So the contribution margin on the variable costing is much different, right? Contribution margin is different than the gross margin because of the cost of goods sold includes the fixed overhead. Well, here it doesn't include it. But then if the amount of units produced and sold, if the amount of units produced equals the amount of units sold, we'll always get a same net income between the absorption costing and variable costing. So if our numbers produced don't equal the numbers sold, we'll get a difference because of the timing of inventory. And because our inventory product costs are different. So this goes and shows you production cost assignments, units produced equals units sold. So this is what variable costing statement and absorption costing statement look like if you have an equal amount of units sold, produced and sold. And so we just built something similar to this, right? We have the cost of goods sold is 1.5 million. And under the variable costing, the cost of goods sold is only 900,000 because it's $10 less per unit. But we have the fixed manufacturing overhead that we add as a period cost, and that gets us the same total expenses. So the main difference is absorption costing, we're adding that fixed manufacturing overhead to the inventory costs or product costs. Which changes the cost of inventory, right? But what happens if we exceed units sold? Well, if we exceed units sold, if our production exceeds our sales, we have more inventory. We're holding more inventory. So it's going to change our income. So it's always going to be the case that if we hold or produce more than we sell, our variable costing is going to be result in less income than our absorption costing. That's because the absorption costing is taking some of the fixed overhead and we're holding it in inventory for later, right? So that's not expensed yet. That's all we're saying. But that fixed overhead hasn't been expensed. We're waiting to sell the inventory. In theory, with the matching principle for the fundamental accounting assumptions. But in the variable costing, we're always expensing those fixed expenses, the fixed overhead. That's always hitting our books. So that's always reducing our income. We don't get away with kind of deferring it in our inventory costs. So that's all we're saying here is that's because of that, we have this adjustment to income, right? Income for 2018 under the absorption method, we get 320,000. Well, under the variable method, we get 120,000. It's because of that. It's that adjustment of fixed costs that are kind of hiding in inventory under the absorption method. So that's just this comparison. That's what it's showing, right? We have under the absorption costing method, we have this additional 500,000 of finished goods inventory, or that difference in cost is coming from, or a difference in cost of goods sold price is being really hiding in that finished good inventory. And it's just that fixed overhead. The reciprocal is true as well. So if we produce less than we sell, the absorption costing income statement is going to have less income, while the variable costing is going to have more. That's because in the absorption costing, we have these fixed costs hiding or being attributed to our finished goods inventory that now are being expensed. While in our variable, those fixed costs are essentially hitting our books evenly. So we get a smoother income statement with our absorption costing, right? Like it kind of mitigates the variability. It smooths out the variability. While the variable costing is going to be a lot more volatile because we take out the fixed expenses and have them hit the books every period. Again, this is just coming from the fixed overhead, right? The fixed overhead's hitting the books here evenly, while it's hiding in the finished goods for absorption costing. And that's that difference in the price per unit. So you can kind of see here how it flows, right? Under absorption costing, you get a smoother flow of income. That's another goal. It's easier to compare when we have it be a smoother flow of income. While under variable costing, we have these wide swings because in this period, we had a lot of costs and weren't able to sell our units. And then in this period, we sold a lot of units but didn't produce them. As you can see how the income changes under the absorption versus variable costing method. Okay, any questions there? I know that's a lot. That's just comparing the methods. And the real takeaway is it's fixed costs. The fixed overhead are hiding or being attributed to the inventory in the absorption costing method, which smooths income over time. Any questions? Going once, going twice. So then how do we convert variable costing to absorption costing? So what if we have a variable costing income statement? How do we change that to absorption costing? And vice versa. So it's just a formula, right? So we're just going to take the equation and then we just have to move around the variables. So income under absorption costing is equal to income under variable costing plus the fixed overhead and ending inventory, right? We've said that's the difference, minus the fixed overhead in the beginning inventory. All we're doing is we're taking we should know the income under variable costing. We should know the amount of fixed overhead per unit. and then attribute that to the amount of units in our ending inventory and our beginning inventory. Why are we adding the ending inventory? Because that wasn't expensed in the income under the absorption costing. And then we take out the beginning inventory because it should have been expensed, right? If they were using FIFO. So here they're taking the variable costing. We have these difference. And then we fixed overhead costs deferred in the ending balance. This is a 20,000 times $10. That's a 200,000. And from the beginning balance, we reverse it out. That's all that's happening. That's the same, just a different view of this. The $200,000 difference. That's just coming from the fact that there was these 20,000 units held in finished goods inventory. And so that can bridge us to the other income statement. So based on all of this, how can absorption costing result in overproduction? So I'm curious, anyone have any ideas here or questions before we get to this?
So can you repeat your question, please?
The question is, why might absorption costing result in overproduction?
Because your costs seem lower than they actually are. We don't know like the exact what thing, like what exactly it costs in different stages.
Yeah, I think that's a good, yeah, because it smooths it out, we don't get to see the exact amounts of production.
Yeah.
So yeah, that's a great call out, Saeed. So you can see when we'll go through an example here, but it messes with our planning when we don't see exactly what's happening month to month.
I think there are like a lot of hidden costs with absorption costing.
Exactly, because it's smoothing it out. You're right. When you're smoothing out the fixed overhead, you don't really see exactly how much contribution margin we're getting every single month, which kind of skews demand, right? It skews our perception of the demand. So it's a great call out. So one of the ways we can test this theory that you just posed, Saeed, so it's a great theory. You have a hypothesis there. And how do we test it is, let's do a sensitivity analysis. So let's say this company, they're called Ice Age, decides to produce 100,000 units instead of 60,000. And so in a fixed or when 60,000 units are produced versus 100,000 units are produced based on a absorption costing. So we're talking about absorption costing here. We can, in theory, lower the amount of total production cost per unit, right? Because we are able to attribute the fixed overhead to more units. So right, we're saying we have fixed overhead of $600,000. And if we're making 60,000 units, it's only $10 per unit. But what if we make 100,000 units? It's $6 per unit. So if this manager gets paid to reduce the costs per unit, he's incentivized to build more units under the absorption costing, because he gets to hide more of those fixed overhead costs or attribute more of those fixed overhead costs into the units. But you can't get away with that in variable costing, right? Because the fixed overhead is excluded, to your point, Saeed. So good observation. Does that make sense?
Yeah, thank you.
No problem. Any other questions on this? You see how this can be dangerous?
Yeah.
We're incentivized to increase units, even though it actually, in actuality, it's not changing our costs. So you can see here, if we change to 100,000 units produced instead of 60,000 units sold, we change to that, we lower our cost of goods sold for the period when we produce those units, in theory, because we're hiding more of those fixed overhead costs, which boosts our net income.
Professor?
Yes.
So when it comes to actually keeping track of the data and all of that, When do we know which one is which? Like, uh, like raw material or direct labor, one, like all those things.
What do you mean?
So when we are actually entering the numbers in the data, when do we know which one is which?
Right, it should be explicit, right? And in any of the questions, it will either tell you it's a direct material, direct labor, fixed overhead, or variable overhead, or it will tie to something we've talked about before. Like it will say this kind of, we know the difference between direct labor and factory overhead. We practiced that in chapter 2. So it'll fall into one of those categories.
Okay, because I've had a hard time determining on the homework assignments, like which one is which.
Yeah, it's as the class evolves, it should get a little easier, but it just comes to going back to the chapter 1 and chapter 2 and understanding what we consider direct materials versus what we consider overhead.
Okay.
Right, and a refresher for everyone, right? Direct materials or any materials directly going into the production of the products. Direct labor is any labor going directly into the production of a product. They're all part of the product costs. Remember, we have the prime costs and conversion costs. And then for the conversion costs, we have the factory overhead or the overhead concept. And the overhead concept is indirect costs, right? So like if we have a salaried employee who oversees a factory, but doesn't oversee the direct production, then that's an indirect overhead cost, and so on and so forth. So just kind of go back through those chapters and make sure you understand it if those as those questions will continue to show up. Good question, Michelle. Thank you. So to that point, right, we're seeing here income under absorption costing on different product levels. We're going back to the 60,000 units produced versus sold. We can see here that under variable costing, even if we produce more units, it doesn't affect our net income. So ultimately, variable costing gives us a more honest report of how we're doing in the month, where there's less ways to manipulate the income amount through production. And so that can be helpful for managers to track the performance of their factories.